gold or Bitcoin? It sounds like a simple debate. Old money versus new money. 5,000 years of history versus 21 million coins. But in 2026, this question isn't philosophical. It's strategic because we're re-entering a macro environment defined by record global debt, fragile banking systems, persistent inflation pressure, potential rate cuts, currency debasement risk. When monetary systems stretch, hard assets outperform. Historically, that meant gold. But now, Bitcoin is competing for the same role. So today, we're not doing opinions. We're doing structure. We analyze monetary policy impact, inflation, correlation, liquidity cycles, volatility-adjusted returns, institutional behavior risk scenarios, and portfolio positioning. By the end, you'll know not which asset is better, but which one fits which environment. Let's decode it properly. Part 1. The macro backdrop of 2026, 2 o'clock to 5 o'clock before comparing gold and Bitcoin. We need context. Markets don't move in isolation. They respond to liquidity. And liquidity in 2026 is driven by one key factor: debt. Global debt-to-GDP ratios are historically high. Governments cannot afford permanently high interest rates, which means long-term. Monetary expansion is likely. That creates 3 possible scenarios. 1. Controlled disinflation plus gradual rate cuts. 2. Sticky inflation plus currency pressure. 3. Recession. Forcing aggressive easing, each scenario affects gold and Bitcoin differently. Gold historically performs well when real yields fall, currency confidence declines, central banks diversify reserves. Bitcoin performs well when liquidity expands, risk appetite increases, institutional capital flows in. So already we see gold reacts to fear, Bitcoin reacts to liquidity. 2 different drivers. PART, 2 monetary policy sensitivity, 5 o'clock to 8:30. Let's talk about real interest rates. Gold is highly sensitive to real yields. When real yields fall below inflation, gold tends to rise. Why? Because holding cash becomes unattractive. Gold becomes a store of purchasing power. Bitcoin is slightly different. Bitcoin reacts more strongly to liquidity expansion than to inflation itself. Example, when central banks print aggressively, Bitcoin often rallies hard. But when central banks tighten, Bitcoin drops faster than gold. So structurally, gold equals defensive inflation hedge, Bitcoin equals aggressive liquidity hedge. That distinction matters in 2026. If rate cuts are slow and controlled, gold may outperform. If liquidity floods the system again, Bitcoin likely outperforms. Part 3. Volatility and risk-adjusted returns. 8:30 to 12 o'clock. Let's get quantitative. Gold volatility historically sits around 10 to 15%. But here's something most investors completely overlook. Gold and Bitcoin don't just compete with each other, they compete with real yields. When real yields rise, both assets struggle. When real yields fall, both assets tend to benefit. The difference is magnitude. Gold responds gradually. Bitcoin responds violently. That's because Bitcoin behaves like a beta liquidity asset. It amplifies macro shifts. So if 2026 brings aggressive monetary easing, Bitcoin likely reacts faster. If easing is slow and cautious, gold may quietly outperform. Understanding real yield direction is more important than choosing a side. Bitcoin volatility can exceed 60 to 80%. That's a massive difference. Now here's the key. Raw returns don't matter alone. Risk-adjusted returns matter. Bitcoin has historically outperformed gold dramatically. But with significantly higher drawdowns, gold rarely drops 50%. Bitcoin has done it multiple times. So the question becomes, can you emotionally and structurally handle volatility? Because if you panic sell Bitcoin during a 40% correction, you eliminate its long-term advantage. Gold is easier to hold. Bitcoin is harder to hold. That psychological component matters more than people think. Part 4. Institutional adoption. 12 o'clock to 16 o'clock. Gold is owned by central banks, sovereign reserves, pension funds, long-term institutions. Bitcoin ownership has shifted. Now increasingly institutional, spot ETFs, asset managers, corporate treasuries, custody infrastructure. This changes the volatility profile over time. As institutional ownership increases, volatility tends to decrease gradually. But Bitcoin is still early compared to gold. Gold's market cap is massive and stable. Bitcoin's market cap is smaller and reactive. That means Bitcoin has more upside potential, but also more downside sensitivity. Adoption curve matters, and Bitcoin is still mid-curve. Part 5. Recession Scenario Analysis, 16 o'clock to 1930. Let's simulate recession. If 2026 brings recession, initially, risk assets drop. Bitcoin likely falls with equities. Gold may initially dip, but historically stabilizes and recovers faster. Then central banks respond with easing. Liquidity expands. Bitcoin rebounds aggressively. Gold rises steadily. So in recession cycles, gold equals stability during shock. Bitcoin equals explosive recovery after policy response. Different phases, different behavior. Understanding timing matters. Part 6. Inflation and currency. Debasement, 1930 to 23 o'clock now. Inflation. Gold has thousands of years as a hedge against currency debasement. Bitcoin's inflation hedge thesis is based on fixed supply. 21 million coins, mathematically scarce. Gold supply grows slowly. Bitcoin supply is capped. That gives Bitcoin a stronger scarcity argument. But gold has trust. Bitcoin has code. Which one investors prefer depends on trust in technology versus tradition. In a severe currency crisis, both likely rise. But Bitcoin's upside could be higher because of smaller total market size. Part 7. Portfolio construction logic, 23 o'clock to 27 minutes and 0 seconds. Now let's move from theory to practice. Professional investors don't ask, which one wins? They ask, how does each asset behave inside a portfolio? Gold reduces volatility. Bitcoin increases volatility but increases upside. If you allocate 5 to 10% gold, you smooth drawdowns. If you allocate 5 to 10% Bitcoin, you increase asymmetry. Together, they balance. Diversification between hard assets is smarter than ideological commitment. Part 8. LONGTERM. Outlook, 27 minutes and 0 seconds to 30 minutes and 0 seconds long term. Gold will likely remain stable, steady, a preservation tool. Bitcoin has higher probability of large percentage gains over the next decade if adoption continues. But it also carries structural risks. Regulation technology shifts, market sentiment cycles. Gold's risk is stagnation. Bitcoin's risk is volatility. Different risk profiles, different investor types. Final verdict, 30 minutes and 0 seconds plus. So gold versus Bitcoin in 2026, which one wins? If your priority is capital preservation, gives gold. If your priority is asymmetric upside, gives Bitcoin. If your priority is intelligent positioning, gives both, because macro environments shift, liquidity cycles rotate, and extreme positioning increases risk. The smartest strategy isn't picking sides, it's understanding behavior. Gold protects, Bitcoin amplifies. Structure wins over ideology. If you want deeper macro breakdowns like this, subscribe to Wealth Decoded. We don't follow narratives, we analyze them.